Hey everybody, it's Larry Berman here. Happy New Year. Been on vacation for the last few weeks. It's almost the first vacation I've really taken in a number of years where I really try hard not to open my Bloomberg terminal and watch markets. And, doing this nearly 40 years now, I found it nearly impossible not to pay at least a little bit of attention. But I did get some quality downtime. I played some of the best golf courses in the world. I've got some great pictures. I'm excited to get back at it for 2026. A lot of economic momentum leading into 2026 where, at times in 2024 and 2025, it looked like the markets were going to start to price in, a downturn in the economy. And while the labor market in the U.S. has softened dramatically, there's every indication that the U.S. administration wants to keep the party going through the midterm elections. There's tailwinds from fiscal policy. There's not material headwinds from trade and tariffs at this point, and valuation market doesn't seem to care too much about at this point. We are seeing a broadening in the rally and some divergences starting to show up. There are longer term considerations to be sure, but the bet now has to be the market keeps grinding higher until it can't anymore. And we're looking for evidence of that. Got some charts to show you. Let's dive into the chart room. So we're looking here at the last couple years of the MAGS, MAG 7 ETF, the Roundhill MAG 7 ETF, and comparing it to the Russell 3000, so the entire US stock market basically. And what we're seeing here to start the year is a little bit of a divergence where we've seen the broader market stay firm and the MAG 7 roll over. In fact, it's been doing that for a couple of months now. One of my technical colleagues out there pointed to this, what's looking like a head and shoulders pattern here. You can see the shoulder, the head, the shoulder, the neckline's broken. But that measured move here, really only takes us down a little bit more. So is this just another bit of a correction like we saw earlier in the year that's still, is the uptrend still intact? Well, technically, we need to start really breaking support for the chart to be damaged. And while we certainly did a lot of that during the tariff noise, as soon as that was reversed, markets reversed. So, what is the bullish catalyst here? Is my question. And so as earnings period started this week, it's got to be earnings. So it's still a couple weeks out where we start to get the big tech earnings. We've gone through the banks, largely mixed, but okay. No material warnings at this point. But it is interesting to see the broader market hold up relative to the MAGs here. And it is noticeable. So maybe Q1 is more of a rotation back into value, back into some of the names that have been underperforming. So market can stay okay, but some of the names come out of the leadership. And so that's kind of step one. Long end of the bond market continues to struggle. Looking at the TLT over the last year, we had talked about many times last year that we really like duration down in this area, but we're contained on the upside by what continues to be a pattern basically of lower highs. And while we haven't made lower lows, and I don't expect that we will, this trend is moderately disturbing. The long end of the curve can't rally in a material way until the U.S. economy falls off a cliff. If the U.S. economy is running hot, and that seems to be the policy backing case now and why the broadening out is happening, and then the long end is going to really struggle here. So, in our active bond strategy, we're doing a lot of covered call, generating the extra income while we think we're in this, relatively narrowing trading range that would call it 5% at the long end and maybe 475 right now, where that long end is contained. Again, a move to the upside. We need strong economic weakness. Obviously, bad for equities, monies would start to rotate. We're not seeing that. When we look at other leadership areas, artificial intelligence, so the AIQ ETF, we've talked about it many times. Failure to make a new high here, losing momentum, starting to see more blue bars in the last number of months. So what's a blue bar compared to a white bar? Opening is up, closing is lower. So during the day in North America, we're seeing selling into what might have been an overnight opening bid, or something where, what's happened in Asia or what's happened in Europe as we get into North American hours has caused futures to go up and a lot of prices. But by the time the day ends, weaker prices in North America. When we look at interest rate outlook on the short end, what's been clear here is President Trump muses over who the next Fed chairman will be, that the market is pricing only a couple of rate hikes out for cuts out for 2 years, and really thinking about one and done this year, two and done. But if I'm right, we don't need a lot of rate cuts now, because the economy's running hot through the midterm elections, again, incentive to do that. You might get one more out of the Fed if they get a couple data points that are soft on inflation or weaker on the employment side. But the hard landing fiscal cliff comes in 27 and beyond. So if we're going to get a more material correction in equity markets and a rally in bonds, it's probably looking like a 27 story right now. While I'm not bullish about 26, again, policy-wise, the backing and support is there, and so far earnings are not disappointing. And really, that's the next leg to define policy here. Can earnings continue to grow at what the market's expecting? Low teens in terms of earnings growth this year. When we look at the commodity side, led by the fear of what's happening with central banks and the fiscal on governments all over the world, hard assets kind of rallying, except for crude oil and the energy sector. So Trump wants lower oil prices through the midterms. They can rise after that. The stuff happening in Venezuela. You have the, more belligerent talk about Iran right now, and the civil war that's developing called protest, but really getting citizens to rise up. Regime change, in my belief, is coming to Iran. I don't know what it's going to look like at the moment, but it's going to be disruptive. And I think part of the Venezuela hoping to build supply and energy is really about the next few years and regime change in Iran before Trump's out of office. So that's geopolitics. That has nothing to do with earnings. Probably shouldn't matter too much for markets, with the exception of how it might impact oil prices. Obviously, spike in oil prices bad for consumer and consumption and trade and everything else. Costs go up. This rise in commodity prices is really precious metal led, and it's not broad-based beyond that, I don't think. But when you go back and look at this BCOM index, for a number of years now, it's flatlined. It looks like it's breaking out again. But in order for this to be a meaningful breakout, you really need robust economic growth. And I'm not sure, other than a little bump here, that we're going to get that to drive commodity prices higher from a consumer demand perspective, not supply shortages and not speculative activity in precious metals. So that's kind of the view as 2026 gets underway. Again, Happy New Year, everybody, and looking forward to getting back at it.